Let me ask you something. What if the most important signal gold has sent in years isn't the all-time high it made earlier this year? What if the signal is what's happening right now? Because while the headlines were screaming about gold smashing records, something far more telling has quietly started playing out beneath the surface. And the people who recognize this pattern, who've studied what gold does at moments exactly like this one, they aren't panicking. They're paying very close attention because they've seen this before and they know what comes next. Gold just pulled back sharply from its historic peak. That's the news everyone knows. What they don't know is what that pullback is actually telling us. And that's exactly what we're going to break down today. The signal hiding inside the correction, the institutional moves happening right now behind the curtain, and why every American who has worked hard to build a retirement nest egg needs to understand what's unfolding before it's too late to position properly. Let's start with where we are. Gold rocketed to an all-time high earlier this year, surging past levels that just a few years ago would have seemed like pure fantasy. Then, almost like clockwork, it pulled back. A significant correction, the kind that shakes retail investors loose, makes financial media pundits declare the bull run is over, and sends the average person running for the exits. But here's what's fascinating, and this is the part that almost nobody in mainstream finance is discussing. Central banks did not blink. Institutional buyers did not blink. The smart money looked at that correction and saw something entirely different from what the panicked crowd saw. They saw a gift. Now, before I go deeper into exactly what's happening and where gold is likely headed from here, I want to mention something quickly. A lot of you watching have been asking me how everyday Americans, people who've spent decades building their savings and are trying to protect that wealth right now, can actually benefit from what's happening in precious metals. I put together a free guide that breaks it all down. It covers the exact saving strategies that thousands of American retirees are quietly using to protect their hard-earned wealth from inflation, dollar debasement, and market volatility. The link is in the description below. It's completely free. Go check it out, and then come back because what we're about to get into is critical. So let's go back to the signal. To understand what's actually happening, you have to understand a very specific pattern, one that has repeated itself with almost eerie consistency throughout gold's modern history. Every major multi-year bull market in gold has featured at least one significant correction that felt, in the moment, like the end of everything. And every single time, the people who understood the underlying dynamics, the real structural forces driving gold higher, used that correction to accumulate. Then the price eventually resumed its move higher, sometimes dramatically higher. Think about what happened in the 1970s. Gold was liberated from the fixed dollar peg in 1971 when Nixon closed the gold window. The initial surge was breathtaking. Then came a brutal correction. Gold fell by more than 40%. The mainstream financial press declared gold dead. Speculators who had jumped in late ran for the exits. But the people who understood the structural debasement of the dollar, the inflation that was baked into the system, the geopolitical instability of the era, they held. Some of them bought more. And gold eventually went on to make a move that left everyone who sold into that correction absolutely speechless. From that post-correction low all the way to the peak in 1980, gold made one of the most extraordinary price advances in financial history. An asset most people wrote off as a relic of the past delivered returns that destroyed every other major asset class during that period. Now, here's the important question, and I want you to really sit with this. Are today's structural conditions more like 1970 or more like 1985? Because that distinction matters enormously. In 1985, inflation had been crushed. Paul Volcker had jacked rates to the moon and wrung inflation out of the system. The dollar was strong. The geopolitical situation, while complicated, was relatively stable in terms of global monetary dynamics. Gold in that environment had limited fundamental tailwinds. Today, let's look at what's actually happening. The Federal Reserve is now being discussed as potentially hiking rates again. And here's the part most people get backwards. That is not necessarily bearish for gold in the long run. It means inflation is still a problem. It means the Fed is playing catch-up with price pressures that have proven far more stubborn than they anticipated. When the world's most powerful central bank is still fighting inflation after years of trying, that is a deeply bullish signal for hard assets. Gold is not just an inflation hedge. Gold is a monetary system hedge. And right now, the monetary system is under more pressure than it has been in decades. Think about the dollar itself. Central banks globally, not just one or two fringe players, but the largest reserve managers on the planet, have been systematically reducing their dollar exposure and increasing their gold holdings. The World Gold Council has documented this shift quarter after quarter. These aren't hedge fund guys chasing momentum. These are central banks, institutions that move slowly, deliberately, and with decades long time horizons. When an institution like that shifts its reserve composition, it is making a statement about where it expects the global monetary system to be not next month, but in 10, 20, 30 years. What are they saying? They're saying they don't fully trust the dollar's long term purchasing power. They're saying geopolitical risks are real and growing. And they're saying gold is the one asset that carries no counterparty risk. No government can default on physical gold. No central bank can print more of it. No financial system can freeze it. The numbers here are staggering. Central banks have been buying gold at levels we've never seen sustained for this long in modern history. Hundreds upon hundreds of tons every single quarter. And even with that voracious demand, even with ETF inflows running at historic levels, even with retail demand from China and India surging, the price just corrected sharply. That's the signal. That's what nobody's talking about. When you see that level of structural demand and you still get a correction of this magnitude, what's causing it? Primarily two things. First, rising treasury yields and a temporarily stronger dollar. Those are short-term, rate-driven forces. Second, some easing of acute geopolitical tensions in the Middle East, which briefly reduced the risk premium embedded in gold. But here's what's critical. Neither of those forces changes the underlying structural thesis, not even a little bit. The dollar's dominance in the global reserve system is being challenged in ways that have no precedent since Bretton Woods. The BRICS coalition, and I want to be careful here because this story gets wildly sensationalized on both sides, is not about to replace the dollar overnight. But what it is doing is creating bilateral trade arrangements, local currency settlements, and deliberate diversification away from dollar-denominated assets at a pace that was unthinkable even 5 years ago. That process doesn't reverse. Once a central bank shifts its reserve composition toward gold, it doesn't typically shift back. The gold stays. The dollars get reduced. Goldman Sachs has set a price target for gold that would represent another significant move up from current levels. JP Morgan, not exactly a fringe newsletter, has outlined a scenario where gold prices could reach levels that would make today's prices look like a bargain. These aren't permabulls in the precious metals newsletter space. These are the biggest, most establishment financial institutions on the planet, and they are telling their wealthiest clients that gold's structural bull market is intact. Now, let's talk about something that most retail investors almost never think about: the actual mechanics of how gold is traded globally. Because understanding this reveals something deeply important about what a correction like this one actually means. Most gold trading globally does not involve physical gold. It involves paper contracts, COMEX futures, LBMA forward agreements, various derivatives, and synthetic instruments, where the actual amount of paper gold outstanding dwarfs the physical metal available for delivery. The ratio of paper claims to physical ounces has been, by various estimates, extraordinarily high. What this means is that price movements in gold, especially short-term corrections, are often driven primarily by paper traders responding to macro data, interest rate expectations, and momentum signals, not by buyers and sellers of actual physical gold. And here's where it gets really interesting. The physical market has been telling a completely different story than the paper market for some time now. Physical delivery demand at the COMEX has been elevated. Premiums on physical gold and silver have periodically spiked above spot prices in ways that signal genuine tightness in the actual metal supply chain. When paper prices correct, physical buyers, including those central banks we discussed, tend to step up. They're buying the dip, and they're taking actual delivery, not just rolling paper contracts. This is the kind of thing that, when it reaches a tipping point, produces extremely rapid and violent price moves to the upside. When the paper price diverges from physical reality for long enough, the paper market eventually has to catch up with where the physical market actually is. And when that happens, the move is often so fast and so large that investors who are waiting for a better entry point find themselves completely left behind. This brings me to silver, and I want to spend a few minutes here because silver is telling us something important. Silver had an absolutely extraordinary run over the past couple of years, a move that shocked even many precious metals veterans. And while silver has also corrected from its highs, the gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is still at a level that historically has occurred near the beginning of major silver bull phases, not at the end. Silver has a dual nature that makes it uniquely compelling right now. It's both a monetary metal, like gold, a store of value, a hedge against currency debasement, and one of the most industrially critical metals on the planet. The energy transition, regardless of where you stand politically on climate policy, requires enormous and growing quantities of silver. Solar panels, electric vehicles, advanced electronics, energy storage systems. The industrial demand for silver is not hypothetical future demand. It is current, documented, and growing faster than primary silver mining can supply it. The result is a supply deficit that has persisted for years and shows no sign of resolving. When you combine structural monetary demand, structural industrial demand, supply deficits, and a gold to silver ratio that historically precedes silver's outperformance, you get a setup that is genuinely rare. Now, I want to talk to those of you who are watching this and thinking about your retirement, because this is where it gets personal, and it's where I want to be completely direct with you. If you are within 10 or 15 years of retirement, or you're already in retirement, and you have a meaningful amount of wealth sitting in traditional paper assets, stocks, bonds, money market funds, you are carrying risk that most people in your position do not fully appreciate. Not because stocks and bonds are always bad, but because we are living through a period of profound monetary instability, geopolitical realignment, and structural fiscal stress in the United States government that has historically been deeply corrosive to the purchasing power of paper-denominated assets. Quick thought here. If you have $100,000 or more in any retirement account, whether that's an IRA, a 401k, or another qualified plan, there's a way to get physical gold inside that tax advantage structure without triggering taxes or penalties. It's called a gold IRA, and the process is simpler than most people realize. I've put together information on exactly how it works, the regulations around it, and how it might fit into a broader wealth protection strategy. All of it available in the free guide linked in the description. No obligation, no sales pressure, just real information that could matter a great deal to your financial security in the years ahead. But back to the market, because there's more happening here that you need to understand. Let's talk about the Federal Reserve's position, because I think a lot of investors are misreading the macro environment right now. The mainstream narrative is that rising rate expectations are bad for gold. And in the very short term, you can see that in price action. When yields rise, the dollar strengthens, and gold often pulls back. That's the mechanical relationship. But zoom out even 12 months, and the relationship completely breaks down. Throughout the 1970s, gold rose while interest rates rose. Throughout the period from 2018 into the great bull run of 2019 and 2020, gold rallied even as rate dynamics shifted dramatically. The reason is simple but profound. Gold is not primarily a trade on interest rates. Gold is a trade on confidence. Confidence in central banks, confidence in the currency, confidence in the fiscal management of governments. And right now, across all three of those dimensions, the picture is complicated at best. The U.S. government's fiscal trajectory remains one of the most serious long-term threats to dollar purchasing power that exists. Debt levels that would have seemed impossible just 2 decades ago are now simply baseline reality. The interest cost of servicing that debt has exploded as rates have risen. These are the kinds of structural pressures that, over time, are deeply supportive of hard assets. Not because there's going to be some Hollywood-style financial collapse tomorrow morning, but because the slow, grinding erosion of purchasing power, the quiet thief that inflation represents, is relentless and it does not stop. Think about what your dollar could buy 10 years ago compared to today. Now imagine that same dynamic playing out over the next 10 to 20 years, potentially at an accelerated pace, in a world where the dollar's global reserve status is being steadily, structurally challenged. Where does that leave someone whose entire wealth is denominated in that dollar? Now, here's something I want to say clearly, because I think it's important. Gold is not a get-rich-quick trade. It's not about sitting down and watching charts and trying to catch a $20 move. The people who have built real, lasting wealth through gold, the families whose purchasing power has survived wars, currency collapses, and financial crises going back centuries, they weren't trading gold. They were holding gold. They understood something that Wall Street has systematically tried to get you to forget, that gold is money. Real money, the kind that no government can inflate away, that no bank can freeze, that no counterparty can default on. When you look at historical moments that rhyme with today, the period just before the massive gold rally of the late 1970s, the setup that preceded gold's enormous move from 2001 through 2011, the conditions that existed right before gold began its extraordinary run over the past several years, the common threads are always the same: monetary debasement, geopolitical stress, institutional accumulation happening quietly while retail investors were distracted by other shiny objects. And then the move, often fast, often violent, often leaving the sideline sitters completely stunned. The difference between those who captured those moves and those who missed them was almost never about intelligence. It wasn't about having access to secret information. It was about having a framework, understanding what gold actually is, why it does what it does, and having the conviction to act on that understanding even when the headlines seem to argue against it. Right now, gold is giving you a window. The correction from the highs has pulled the price back to a level that, in the context of the structural bull market we are in, represents something potentially extraordinary, a chance to accumulate at prices that, if the structural thesis plays out, will look remarkably cheap in retrospect. The smart money knows this. The central banks know this. Goldman Sachs and JP Morgan know this. The question is whether you know it and whether you act on it. There's a confluence of signals right now that I genuinely don't think the mainstream financial media is equipped to process properly. You have a price correction, which everyone can see, but beneath that, you have central bank demand that hasn't wavered. You have physical market tightness that the paper price is currently ignoring. You have a structural dollar story that hasn't changed. You have a fiscal situation in the United States that hasn't changed. You have geopolitical realignment that, regardless of whatever temporary ceasefires get announced, has not changed its fundamental direction. All of these structural forces are pointing in the same direction, and the pullback in price is not a refutation of those forces. It's a temporary divergence caused by short-term paper trading dynamics, the kind of divergence that historically resolves by the paper price catching up to the structural reality, not the other way around. So, what do you do with all of this? That's the question that matters. And the answer is different for everyone, because your situation, your age, your assets, your risk tolerance, your timeline is unique. But here's what I'd encourage you to do. Start by educating yourself, really educating yourself. Not just reading headlines, but understanding the mechanics of what's happening in precious metals markets, what your options are for exposure, and specifically, if you're a retiree or approaching retirement, how the structures available to you, like a gold IRA, could potentially play a meaningful role in protecting what you've worked your entire life to build. I've mentioned the free guide a couple of times today, and I want to be specific about something for those of you who've stayed with me this long, because there is something I've set aside specifically for viewers who make it to the end of videos like this one. If you are an American retiree with at least $100,000 in any retirement account, an IRA, a 401k, anything qualified, and you'd like to actually talk through your specific situation with an expert, there is an exclusive complimentary one-on-one educational web conference available to you. No obligation, no sales pitch, just a real conversation with someone who can walk through your individual circumstances, explain exactly how precious metals could fit into your retirement strategy, and answer every question you have. To access that, just mention this video when you reach out through the information in the description below. It's available only to American retirees who meet that threshold, and it's the kind of conversation that can genuinely change how you think about protecting your wealth. The signal gold just sent is not one of warning, it's one of opportunity. The question is who recognizes it and who acts before the window closes. The institutions already know what they're doing. Now, you do too.